Hello, and thank you for joining me. My name is David Hansel. I am one of the founding members and managing partners of Lucern Capital. We are a real estate private equity firm based out of Red Bank, New Jersey, and we primarily focus on making investments into multifamily apartment buildings and industrial warehouses. Over the years, we've put a lot of our efforts into the Sun Belt, specifically North Carolina and the Charlotte market. So we've built an incredible team and resources that allow us to not only find great opportunities off market, but to be able to execute on these deals with a great team. So today I want to welcome our current investors or past investors of Lucern. Thank you for joining us, and certainly for anyone new, welcome. I hope that you'll find today helpful, and today you'll be able to look at this opportunity with us, and if you're interested, to connect and be able to participate in this new investment. So let's get started. I just want to mention in the top right corner, you'll see a QR code. That'll be on most of the pages as we go through. At any point, if you want to scan that, you'll be able to fill out some info if you have an interest in participating with us in this investment, and you can express your level of interest, and we'll connect with you and go over more details and walk you through what it would take to move that forward. So as you could see here, Crosslake Park is an industrial flex warehouse where you have retail up front and industrial bays in the back. This project, we're targeting a 13% IRR, which is kind of an equivalent to a 1.75 multiple on a 5-year hold. Most of our investments have been targeted for a 5-year hold, and we've transitioned in and out within a 3 to 5 year period. Depending on market and situation, we could potentially hold up to 7 years, and we could sell earlier. But we're targeting this 5-year period for our hold. We anticipate that the average cash yield over the life of this investment will throw off about a 7% annualized return. These returns will be distributed in quarterly distributions based on available cash flow per quarter. So before we get too much further into this, I just want to go over a quick disclaimer. I am not an attorney, but I want to share with you that this offering is an offering for informational purposes, but not to constitute a specific solicitation for investment. Everyone that would participate would have to read and review the private placement memorandum, and they must be an accredited investor. Anything that we talk about regarding taxes, you need to speak with your accounting professionals and get advice from them. So now that we got that out of the way, let's go in and start talking more specifically about the deal and the opportunity. So on the right-hand side, I've extracted some bullet points here. The acquisition price for this asset is $7.8 million. We intend to raise a little over $3.4 million in equity that will come from us and investors that wish to participate. That includes all of the down payment money, the closing costs, and also a CapEx budget that I'll get into later and talk about. I do want to quickly mention that the size of this equity raise is on the lower end for us, and we do expect that maybe even after this webinar and the Q&A today, that it could get filled up immediately. So if you do have interest, like I said, scan that QR code and you can just put that in, and we'll make sure that we reach out to you. As I mentioned, the property was built in 2007. You can tell from the pictures, very high quality construction, brick and stucco, nice architectural features. The building itself is 55,000 square feet. There's 2 separate buildings. There's a building that is purely warehouse and another one that's split warehouse with a storefront on the upper level adjacent to those units. Currently, the building is 100% occupied, and I'm going to get into the rents and where we see opportunity to move up the income on this property and also cut some expenses. that will help improve our bottom line, which in turn will bring more profitability to us when we eventually exit the asset and enjoy cash flow while we own it from cutting expenses and increasing income. As I talked about the building itself, you can see a couple photos here. Even the landscaping and the signage is great. It's in a very good location. I'll touch on that more later. There's a couple large interstates that is in close proximity. We are going to put in, like I mentioned, $350,000 in capital improvements. It's not set up specifically for any one item. We have some money for reserves for miscellaneous items that could come up. And I'll touch on a little bit more that we have a nice plot of land with additional building lot that we are looking and exploring and intend to make some outdoor storage, which is definitely a need in this market and can drive additional revenue. So we're buying this asset at basically $142 a square foot. To build this today would be north of 200. That doesn't even include the land. So we're obviously getting at a discount to replacement cost. The business plan specifically, whenever we buy a new asset, when we start, we look at, okay, what are the current numbers? What's the current tenant base look like? Are there expenses that are out of line? Are there rents that are too low that have not been moved up to match up with the current market? So what's really interesting here, I talked about the additional land that could help us generate additional revenue, but we're going in on this asset with current rents in place that we think are discounted to market at a 7.2 cap. So that's a very juicy number as far as, the market has made some turns and we're seeing some better overall returns. It's the effective return taking debt out of the picture. 82% of the tenants that are occupying the property right now are in what's called gross leases. That means that we, as the owners, are paying for expenses like insurance, taxes, operating costs for common areas. And not only that, rents are below market. So we are going to shift right out of the gates. We're going to start to transition all of the tenants to what's referred to as a triple net lease. This will shift the burden of those expenses directly over to the tenants, thereby allowing us to plan more suitably, because obviously you have variables like insurance and you have utilities that can oscillate, and no longer will we need to incur those on our side of the balance sheet. The tenants will. So in doing that, we see right now that the blended rate that the tenants are paying is $11.96 per square foot. If you back out the losses that we're getting from not charging the tenants the money that it's going to cost for the utilities and the taxes and insurance, it's effectively $9.72 a square foot. We've conservatively underwritten this at 13, which we think we can easily achieve actually through some of our due diligence, and our team has been down there a couple times already. One of the adjacent properties, or a property in the town, has been inking and writing up leases at a $15 square foot range, and we're targeting in our return profile 13. So we always try to be conservative with that. Some of this information here is a little repetitive, but I will point out to you there are a really nice diverse tenant base, and we'll go through some of these tenants that are there now. And I'll also talk about some leases that just recently got executed that really helps prove out our thesis. So there was a renewal and a new lease that came while we were in contract negotiations and due diligence. So let's dive into some of the numbers. The next slide, I'm actually going to show you what it would look like if you made a $100,000 investment, and what the prospective numbers will look like. But big picture, again, $7.8 million in an acquisition price, $350,000 we've set aside for capital improvements. Estimated closing costs are just a little under $300,000. And the total project cost, when you add that together, is a little over $8.4 million. And again, of that, we're going to raise in equity from ourselves and other investors that would like to participate and are qualified, this $3.4 million. The stabilized yield on our cost is an 8.3% annualized. And again, the targeted IRR, which is effectively your true rate of return, taking into account time and money, is 13%. And we anticipate cash yield or distributions over the life of the investment to oscillate between 5.5% and 7%. Moving right along, this slide is the hypothetical growth of a $100,000 investment. Again, while we're here and talking about that, if you want to click on that QR code, you can certainly just put in your information, and there's different levels of interest that you can show us on a pull down. But let's get down and talk about this hypothetical growth of $100,000. So if you look in the investment sale column, in column number 3, you'll see negative 100,000. So day one, you're putting 100,000 in. And you can see as you go down the years, the multiple years of the holding period. The principal return every year will be distributing these dollar figures. You see in year 1, 5,000, 6,000 and change, almost 7,000. Those are distributions from the cash flow of the property. We're going to treat it as a principal pay down, which will help from a tax perspective. But you can see that in year 5, based on an exit sale, that there'll be an additional 75,000. And on the next column, it shows the profitability, right? The total distribution. On this $100,000 investment, if you look to the bottom in blue, you'll see that there's $174,588. So what we're targeting is, if we're holding this for 5 years, we're anticipating that your $100,000 investment would throw off $74,588 in profit. So your total return, including principal, would be $174,588. That equates to like a 1.75 multiple. And obviously you can see the profit again there on the side. So happy to discuss this with folks if they have questions. We're going to move along to the debt that we're going to obtain. Obviously, when you're buying an asset, you're getting debt and you're bringing equity. The equity is coming from us and the investors that choose to join us. The debt piece, whenever we're going out to buy a new asset, we go out to market and find what's the best capital source based on what our strategy, our holding period is, what capital we need. We have some very strong relationships through the capital markets and debt markets. We will be obtaining financing from Arrowmark, which is a life insurance company-based lender. They can be very aggressive, and right now, with a lot of the banks having pulled back, the life cos are filling a really important gap. One of the things I want to point out here is that we're borrowing 64% of the total purchase price. And so that gives us a buffer of almost 35% of our own equity in there. It also helps keep the debt cost down. We're going to get the term will be for 5 years. If we sell earlier, there will be some prepayment penalties, which you can see a little bit further down. That step down 5, 4, 3, 2, 1, what that means is that if we sold and flipped the property in year one, we would have to pay 5% of the loan amount. As you move along, that goes down. So if we sell in year 5, it'll be a significantly smaller fee. We are able to lock in fixed rate debt for 30 years at 6.26%, which is very attractive. And we have strong DSCR, which is debt service coverage ratio. So a 1.0 means that the revenue of the property is generating just enough income to cover the mortgage, right? So the higher you go, a lot of banks want to see a 1.20 or higher, sometimes 1.25. So you can see here with having a 1.58 going in, 1.88 stabilized, produces a lot of cash flow over the cost of the debt. So that's a very positive thing and gives us a lot of buffer and protection. Part of what we do, and for those that have worked with us in the past, we asset manage. We hire local property management to handle the billing, handle the leases, managing security deposits, dealing with evictions if we ever have it, any maintenance issues, which, you know, on warehouse tends to be very, very minimal. You have your common area stuff, but the units individually, the tenants will take care of themselves. But this group is based out of Charlotte, and they've been in business for 50 years. They have a brokerage and management company. They're a great partner for us, and we're really excited to have them on board and working on this project. So we're almost done with the property stuff, and I'll just touch a little bit about Lucern itself, maybe another 15 minutes or so. These are a couple of the tenants. We have a large gym that takes about 8,700 square feet. Part of what we did was negotiate a full year's worth of escrow with the owner because they are the largest tenant. We wanted to make sure that we had those dollars set up. That will help us you know, create another buffer. And that's kind of what we do. We're always looking to de-risk, and whether it's through the debt, through our companies that we work with, or how we structure our deals with our tenants. So we have a chiropractor that's been in business for 12 years. He's had multiple offices and is a vibrant location and continues to do well, and we expect them to be with us for hopefully a long time to come. This group, Lustra, was a recent lease. I'm going to go share a little bit more detail about them. These were the tenants that came in during our contract negotiation. We were able to work with the seller to put the terms together. And then Spire is another tenant. These are just 4 examples of some of the existing tenants, and they're a graphics and marketing design company. This is really, really important and really kind of speaks volumes of why we're excited about this investment. You know, obviously seeing that it was a great asset in good quality condition with little need for CapEx and some upside in rents and expense sharing with the tenants, the fact that rents were below market really creates opportunities. So these increases in rent were not factored into our initial underwriting, which kind of tracks us already ahead of the curve of what we were anticipating. So Easy Limo is another tenant. They're existing. We did a renewal with them. We got some nice increase on that of 5.11%, based on a 7 cap, which, by the way, a lot of these assets, these industrial assets, are trading at lower caps in today's market. You know, you're seeing some stuff in the 6s down to 5 for larger assets and really, really good quality products. So we're really buying well here. And the nice part about it is that if you look at the value created at a 7% cap, based on the income that we get, when you sell an asset, it's a multiple off the bottom line. So by driving this additional rent, we're increasing the value of the property by approximately $57,000. What's even better is if you look over to the right, Lustra is a new tenant that just joined us. We were part of the negotiations as well. This was a 53% 0.63% increase over the previous tenant. Now, I'm not promising that we're going to be moving all the tenants up this much, but this was not factored initially when we were looking and underwriting the deal and the return profile that we're projecting. So creates a buffer. That brings an extra $19,000 and change to the bottom line. And at a 7 cap, that's a $275,000 increase in value. That's profit for us and the investors that are part of this project, assuming that all of these things remain constant. And I aggregated those at the bottom. You could see that between these two leases, it's effectively another $333,000 in total value. And that's really exciting. This doesn't always happen, and it allows you to have a lot of breathing room as we move forward. I'm going to touch on the location a little bit more. Mooresville is called Race City. It's adjacent to the Mooresville Motorsports Center, and it's home to many of NASCAR drivers, the drive teams, and all of the services that the businesses that support the racing industry. So there's a lot of demand for this type of flex warehouse. The population has been growing exponentially over the last several years. It's just a quick drive down into Charlotte, about 25-minute drive into Charlotte. It is located in Iredell County, which boasts of extremely tight vacancy rate in industrial at 2%. That means 98% of the market is fully rented. And it had 12.9% rent growth last year. Part of the reason why we came down to the Carolinas in the first place was we saw opportunity not only in creating value in some of these assets, but there's obviously with COVID, there was a huge shift in population, and the Carolinas has been one of the biggest beneficiaries of population movement. And you're seeing a lot of development and growth, and all the businesses and industries that need warehousing to service the growth of the population is going to continue to grow. It's located close proximity to 3 major highways, one of them that's just a mile away, I-77, and that takes you down to it'll take you out to West Virginia and down to South Carolina. And unemployment there is extremely low. I know that the government's been trying to break that a little bit to help with inflation, but its unemployment rate is at 2.9% with a median household income of $70,000. So these are folks that spend money, that have a good income, and the cost of living is considerably less than it is up in the Northeast. $70,000 will go a lot further, although I will say that over many years as that continues to grow, I'm sure salaries will grow, but that eventually will not go as far. But right now it's considerably more than earning $70,000 up north. And since 2018, there's been almost $2 billion of corporate investments that's flowed into this county, 547 million of which was in Mooresville, including 212 million from 2022 to the present. So lots of growth. You want to be in the path of progress. It's like swimming downstream and makes everything easier. These are just some photos real quick of some of the interior space. You could see the gym. You could see the quality of the interior and some of the warehousing. Really nice property. And again, some more photos from the exterior. I wanted to just do a quick dive into some of the industrial assets that we currently own and operate. A lot of our investors have participated in our multifamily value-add assets. We've been making a shift to industrial because we're seeing a unique opportunity, kind of like what we saw 5 years ago, 5 or 6 years ago when we started buying multi down in Charlotte. There was a lot of old ownership. That old ownership was had a low basis, was making really good income. And sometimes if you're not a professional management company or investor, you may not push rent. You're happy, you don't want to deal with the headaches, and it creates good opportunity for new investors to come in. So we can come in, and we're seeing a lot of this in the industrial space, where a lot of the multifamily over the last 5 years has been picked over. There's still opportunities there, and we'll still acquire those assets, but we're seeing a lot more in the industrial. So Ardenia is a 34,000 square foot asset that we're finishing construction on. That's actually up in New Jersey. And another asset, 50,000 square feet down in Charlotte as well. So right here are my two partners. Obviously, I'm David Hansel, Frank Forte, who really oversees the acquisitions and dispositions. All of us get involved, but he kind of runs point on that and a lot on the asset management. Mark handles a lot more of the long-term planning and strategy, and I work a lot on our capital markets, involved in the asset management, and also on the debt side. So we're going to kind of quickly go through these items. This is just a little bit more background about Lucern, and we can wrap up. Again, when I get to the last slide, you'll see the QR code. Feel free to scan that. So between the three of us, we have over 60 years of experience, have transacted on over $2 billion of transactions that combine both debt and equity. We have a very disciplined approach, and for those that have invested and look at our previous track record, we've been very, very conservative. We've put out about we've acquired $237 million in assets with a historical average of exited deals at 33% project level and 1.7 multiple. We've executed 16 transactions through the life cycle of our business, and we kind of take the approach of being hyper-focused in markets, like really knowing the areas that we're in. We're looking for upside that we can create value, not just wait for the appreciation. So we spend a lot of effort fostering relationships with the brokers and other owners and attorneys in these local markets. Most of the deals we've been able to acquire have been off market, and it's really helped us buy at a good basis. So our track record's in here, maybe a little bit difficult to see on the slide, but this shows you the projected IRR returns that we put out when we acquired these assets, and then what we achieved. And the investment type talks about the detail of what the project was. Was it a heavy value add with heavy construction or light? So you could see that we've been able to execute across lots of different types of assets. So what makes us different? We built our own systems and process, and certainly everyone has them, but it's a proven system that's helped us buy and be conservative in our analysis. We are, in my opinion, really strong at sourcing deals, and we put a lot of effort into it. And just by virtue of what we've acquired and the bases that we acquired them over the years speaks volumes. We are active in the asset management. We have a great team with analysts, asset managers. We have folks down in Charlotte area. We also frequent that area. My partner Frank was just down there. I'll be heading back down next week. But we're integrated with the management company on a daily and weekly basis, tracking, the health and the movement of the property. And we focus on yield. We're always looking at principal protection, but looking at the opportunity to create return for us and for the investors. and we try to size up the deals and investment periods that don't expose us to drastic changes in the market. However, with that said, we were all thrown a loop with COVID, which has created some challenges and opportunities, and we really think that going forward, we're starting to see more and more opportunities, and that will only progress over the next year or two. We're just about done here. Wanted to just show you about the investors. We have a really diverse investor base. We have a couple institutional investors. We have some IRA money, joint accounts for married couples, individuals, but we're able to work with lots of different investors, and it's interesting also to us that we appeal not only to the retail investor, but institutional investors who do this for a living and feel comfortable and trust our process, our system, how we communicate and handle stuff. So over the time that we've been in business, I put a breakout of some of the assets that different types of assets that we acquired. We have put in over 170 investors into our assets over the years. 98% of them have returned and done additional investments with us. And from those investors purely into these equity investments, we've raised a total of $48 million. Okay, so as we're wrapping up here, I wanted to thank you for your time. We're going to open up for some Q&A. Again, you can scan this QR code to express interest. We're happy to talk to you, answer questions you have, and go through that. Before I jump off, one thing that I forgot to mention, and one of the strong benefits of investing in real estate, be it multifamily, industrial, or retail, is that you get your share, or get a share rather, of the depreciation of the asset, which helps curb your tax liabilities during the years that we own this asset. So a very important reason why you'd want to invest. Not only are you going to achieve hopefully the returns, or maybe even better, that we are projecting, you'll get these tax benefits along the way, and that's really important, and can help you in your portfolio. So we're going to turn over and open up for some Q&A.